investment is run by a bunch of investment bankers, and their modus operandi.
Hello, I'm Fernando Luque, editor for Morningstar in Spain, and I'm joined today by Asbjørn Trolle Hansen. Asbjørn is the manager of the Nordea One Stable Return. Thank you for being here, Asbjørn.
Thank you for having me.
Well, let's begin by talking about diversification. Do you think that having a good, correct diversification is the secret for getting stable returns over the long term?
I think you are hitting the right thing. I think diversification is actually the only free lunch you have in financial markets. So if you get this right, then that is a good way to create stable return. It can probably also be done in other ways, but this is clearly the way that we are trying to deliver the stable returns. Now, historically, that has been possible by essentially just investing in AAA or AA rated government bonds on one side, and then maybe equities or credit bonds like high yield on the other side, and then keeping the risk balance right so that you make sure that you have as much coming from the government bonds in terms of risk as you have from the equities in terms of risk. So if you have this balance right, then in recessions your government bonds will help you, and in recoveries the equity position will help you. And in that way you keep the balance in the diversification, having an equal amount of risk coming from these two components.
Okay.
The tricky thing is, of course, that government bond yields are so low now that if they should diversify also in the future, then interest rates would have to fall a lot more than they probably can. So I guess the answer is that diversification, to me, is still the most important driver for stable returns. But it is easier in the past than it has been and will be in the future. So you really have to put some effort and value added into making sure that you keep the diversification, and you work with the situation that government bonds do not help you as much on the diversification in the future as they have been in the past. This is where we are spending a lot of time to make sure that you can keep a good, balanced, stable portfolio without even having the government bonds in there.
Okay, so diversification is very important, and so asset allocation is very important. What is your current asset allocation, and is this asset allocation has this asset allocation changed a lot during these last years?
Yes, it has, and as I said, we don't have a lot of government bonds in the portfolio anymore. Instead, we have been trying to get risk diversification in another way. So you can say we have traded a bit out of government bonds. That is a position we had a couple of years ago, that before 2010, that is a position that is no longer in the portfolio. Also recently we have sold all essentially of our investment grade exposure. So over the last year we've rotated out of that as well. And in that way the duration position in the bonds, the exposure to interest rates, have been reduced. So these two significant changes is something that we have done in the portfolio. And instead we've traded in very short duration instrument, very short duration covered bonds and mortgages to still have a good cash buffer in the event that a recession comes around, which we don't think, but if it comes, there's a cash buffer to protect the returns.
Okay. And what about equities? Because I think that a significant part of your portfolio is invested in equities.
Yes.
But which type of equities? What characteristics are you trying to incorporate into the equity part of your portfolio?
Yes, and here comes also, you're right, that there's still a lot of equities in there to drive the return. And here comes the interesting part, because when you lose diversification by not having government bonds in there, so you don't have an asset class that protects you if the next recession comes around, then you need to make sure that on the equity side, and the equities you have in the portfolio are equities that have less risk than you would normally have. So on the equity side, we focus a lot on what we call stable equities, equities with low risk, equities where the fundamental earnings, fundamental cash flow develops in a stable way, and at the same time they look attractive on valuation. So in terms of equities, I mean, we have 50% equities in the portfolio, but it's almost only very stable equities that are not as sensitive to the business cycle, are not as sensitive to a forthcoming recession, if at some point such a one comes, and at the same time with the stable cash flow, they look interesting on valuation. They're not trading on too high multiples. So our stable equity portfolio have maybe a multiple of 12 times 2013 earnings on the basis of very robust earnings that are, almost following a line. So that is a very defensive position that you then keep the diversification alive.
Okay, and could you give us a couple of examples of companies that or sectors that meet these requirements for incorporating in the portfolio?
Yes, absolutely. I mean, I guess that also here we have some rotation in the portfolio. Historically, for example, we've not had a lot of IT companies simply because they have been too expensive. Also, 5 years ago, even though the IT bubble is somewhat behind us, a long time behind us, then they still looked expensive 5 years ago. They are now starting to trade at more decent multiples on the back of stable cash flow. So companies like Microsoft has been taken in over the last years. Companies like Oracle, that again produces a stable cash flow on the back of their software agreements. Companies like Johnson & Johnson also, not an IT company but a healthcare company, is also something that is a large holding. So also again a company that has very stable earnings and stable cash flow on the back of a decent valuation. So healthcare and IT are now two of the largest sector allocations. Historically, 5 years ago it was maybe more companies like Nestle, Novartis, Nestle, which is a consumer staple, that is still a very so we are rotating out of those expensive stable stocks and into the more cheap stable stocks that we see in the healthcare and IT segments.
Okay, well, excellent. Thank you, Asbjørn, for your views on the Nordea One Stable Return. Thank you very much.
Thanks.
Is run by a bunch of investment bankers, and their modus operandi